$84 trillion is set to change hands over the next 20 years. Whether you're passing it down or inheriting it, the decisions you make today will shape your family's financial future for generations. Welcome to the Great Wealth Transfer, where David Pulcini, CFP, guides you through the strategies, insights, and pitfalls of navigating one of the largest financial shifts in history. What you don't know could redefine your legacy.
In this episode, I wanted to address some frequently asked questions that I have been asked over the last couple of months, and these questions are coming from everywhere. They come from friends, from people at the gym, from the soccer team, from basically just being around. And let's just get into it. The first one that I hear, this is the most frequent question that I've been hearing recently. I don't know if this has always been the case, but certainly more recently. And I'll hear this from the guys in the gym locker room talking about this all the time, or the folks eating lunch next to me at the restaurant. And I don't think that I have ever heard this talked about accurately, and I never interrupt, as hard as that is, right? So, and the question is some version of this. If I give my adult children $50,000 or whatever the number is, who pays the taxes on that? Or another version would be, I know I'm over the limit. If I gift X, how much will I owe? And fill in the blank with that X, because people are all over the place with that. Okay, so great question. I get this so often that I might just save this clip in my phone and start sending people the video when they ask, or just hit play at the gym or at that restaurant. So here's how it works, and here's the breakdown. There's a lifetime gift limit, okay? So in 2025, you can gift up to $19,000 per person without filing a gift tax return, okay? So if you give more than that, you need to file a form called 709. It's an IRS form 709. But you likely won't owe any taxes unless you exceed your lifetime exemption, which is currently $13.99 million. Okay, so let me say that again. If you give $17,000 to your child, you don't have to do anything. If you give $20,000, you have to fill out IRS Form 709, and you're going to have to claim that $1,000. I'm going to get into that in a second. The recipient never pays income taxes on this gift. Get that all the time. Will I burden my child with taxes if I gift them something? No, you won't. The giver reports it, but like I said, they rarely owe anything unless they've already transferred millions and millions of dollars, okay? And you know what? I want to make something clear, because many times when someone wants to gift, they want to take money from their IRA or that pre-tax retirement account and then gift it. If you do that, you will have to pay taxes when you take the money out of that retirement account, okay? Then it goes to, let's say, your bank account, and then a gift. So the gift itself is not taxable, but the act of taking it from the retirement account is, okay? So let me give you an example of the whole thing. You give your daughter $50,000 from a bank account, let's say, this year. That is $31,000 over the exemption. You file a gift tax form, subtract $31,000 from your lifetime exemption, so it's $13.99 million minus $31,000, and you move on. No taxes are due. It's simple, but that paperwork matters, okay? And interestingly enough, I wanted to check on this exact situation and let's assume the laws stay exactly the same. So if you did that exact gift, the $50,000 every year, $31,000 over the exemption, you'd have to do this every single year for, you ready? 451 years to trigger any taxes, okay, to go over that limit, all right? Now, will laws change? Of course they will. What if the limit is lowered? That's actually our next question. But for now, if you are planning on making a gift or a large gift, talk to your advisor or your CPA and make sure it's done properly and documented correctly. Don't listen to those folks at the restaurant or the gym, okay? I'm telling you, we have to be 0 for 1,000 on folks handing out that information, okay? Question number 2. What happens if the estate tax exemption drops? Could my family suddenly owe hundreds of thousands of dollars in taxes? The answer could be yes, by the way. But right now, most people feel safe. The federal estate tax exemption is nearly $14 million. I told you $13.99 million in the previous question per person, or about $28 million for married couples. But here's the thing, that might not last. For decades, the exemption was much lower, and Congress has the power to change that, okay? So let's go extreme for a second. Imagine that estate tax exemption drops from $14 million to $1 million. You pass away with a $3 million estate, your house, a life insurance policy, maybe an IRA, a couple of vehicles. Let's just say that adds up to $3 million. Now, if that overall limit is $1 million, your estate owes 40% tax on the $2 million over that limit. Okay, that's $800,000 lost to estate taxes. Okay, and remember, life insurance counts. Okay, more specifically, I should say the ownership of the life insurance counts. Just because it's not in your checking account doesn't mean it's not part of your estate. Okay, and let me say this again for the record. A drop to $1 million is severe. Other laws would have to change, and it's highly unlikely, but I wanted to prove the point with some easy math. And with that said, here's the question I would have for you. Who is watching that limit for you? If you are building wealth, especially with real estate, retirement accounts, life insurance, you need to think about strategy. There are tools that you can use, irrevocable trust, gifting strategies, a lot more that I'm not going to get into right now, that can help you lock in today's rules, okay? And I always say this, I would plan like the exemption will shrink and just hope that it doesn't, all right? Next question. Should I put my house into a trust? All right. The short answer here is if you want to avoid probate, maintain control, make things easier for your heirs, then yes, it's often a great move. Okay. The trust avoids that court process after you pass. Your successor trustee, the person that you put in charge, can step in and handle things quickly. No waiting, no court fees, no frozen accounts. Actually, let me give you a real example right now. I worked with a client recently named Marie. She passed away with a house titled in her trust, okay? Her daughter sold the home 2 weeks later. No probate, no delays. Her neighbor, this is real, basically the same house, no trust. They went to probate, and it took about 14 months to settle. And some of you are nodding your head right now because you've had to deal with this. Maybe it's a parent, an aunt, an uncle. You've heard stories, and most likely you've dealt with the less favorable version of this going through the probate and the waiting, okay? There are ways to take care of that, all right? If you become incapacitated, a revocable living trust also allows you to put your trustee on to manage the property on your behalf, all right? So that all sounds good, but what are the downsides? And as we know, no strategy is perfect, and let's go over a few disadvantages. Number one, I would say, is it's the cost. It's more expensive than a will. You can expect somewhere between $1,000 to $5,000 to set it up properly. If you have several more properties or accounts, it could cost more. If you have an easier situation, it might be less. Basic guideline, $1,000 to $5,000, okay? You have to do some paperwork. You have to retitle your home into the trust. I've seen this before. If you skip or forget to do that, it's basically as if the trust didn't exist anyway, and you set that up for nothing, okay? So you have to nail that paperwork. Refinancing a house that is held in a trust can also be tedious and a little bit of a pain. Some lenders want you to remove that house from that trust to refinance, and then you'd have to put it back in, okay? No asset protection. This is the biggest one. I should have led with this one, actually. A revocable trust does not shield your home from creditors or the nursing home. That is why people want to do it, right? You want to put your house into a trust because you're saying, I don't want the nursing home to take it. Well, if it's a revocable trust, that does not shield the nursing home from being able to go after some of the value of the home, right? They're not going to be able to take your home. I'm not going to get into that right now. But if you truly want to remove it from your estate, that would be an irrevocable trust, which is a different set of issues, okay? But we're not talking about that right now. What about the maintenance? If you buy a new home, you'll need to title that into the trust as well, or it could also go through that probate process anyway. So if you move, don't forget, it takes some maintenance, and you better review that, okay? And it also might be overkill to use a trust. In some states with easy probate rules, the trust might not even be necessary for a simple estate, okay? So the key here is to weigh the complexity of your estate, your state's probate rules, and always your own goals, okay? If your home is a major asset or you just want peace of mind, I would talk to your estate planner, the attorney, about the pros and cons of using this trust, okay? Next question. How much in taxes do my beneficiaries owe if I pass away? And let's clear this up. Most people will not pay estate taxes when they inherit, okay? But there are two types of taxes to consider. There's number one, those estate taxes, and number two, income taxes on inherited accounts. So federal estate tax only kicks in above that $13.99 million per person in 2025. Most families don't hit that. State level estate taxes can start much lower, okay? Especially in states like Massachusetts or Oregon. It depends on where you watch this, okay? I'm not going to go through every state. What trips people up is the income taxes on these retirement accounts. So let's say your kids inherit a $1 million IRA. I see this all the time. That is taxable income. They now have to take all of that money out, typically within 10 years, and may pay taxes at a much higher rate than you ever have, okay? So when we're meeting with folks, we want to start planning today. Consider Roth conversions. Fill those tax brackets up. Are there charitable strategies or trusts or to control how this money is taxed, okay? We can plan tax-wise just like we can plan for any retirement income or financial planning, okay? Your beneficiaries would end up with much more if you could plan around your own tax brackets, the current rules and rates, and leave them the right type of asset, okay? This should be built into the process of meeting with really any financial advisor, okay? Next question here. What happens if you die without a will? And the legal term here is intestacy, and your state decides where your assets go, right? If you don't have a will, if you don't have a plan, the state has a plan for you. I've heard that over and over again. If you don't have a will, the state is going to tell you or tell the remaining folks where your stuff goes, spouse, kids, estranged siblings. The state has a formula for it. It could go to any of these people. It does not matter what you wanted. It's only what is on file or not, okay? The paperwork has to be done. Let me give you an example. I had a client whose brother passed away unexpectedly. He had no will. The girlfriend that he lived with for 10 years, she got nothing. Everything went to a cousin that he hadn't spoken to in 20 years, okay? That was just the law in the state in this case, okay? Obviously a lot more going on there, but that's what ended up happening. So a will, folks, is the absolute minimum. I've said this enough. It doesn't avoid probate, okay? But it does make sure your wishes are known. So do it, get it signed, store it safely. We've talked about horror stories of folks not keeping their will in the right place, okay? Last one for today. Do my kids automatically get everything if I pass away? The answer is not necessarily. So if assets are jointly owned or they have beneficiary designations that are not them, those would pass outside of the will or the trust, okay? I've said this so many times and people still get this wrong, so I'm going to keep on saying it. If you have a will that you've just updated and you've changed the beneficiaries on the will, but you have accounts, so you have an investment account or an insurance policy, and the beneficiary is different, the accounts win. I'm going to keep on saying it. The updated will that you just did last week, that doesn't matter. You have to change it on the accounts, and you should coordinate the beneficiaries, okay? If there is no plan in place, again, the court will decide. Also, if your kids are minors, they can't legally really inherit money. That money goes to a custodian or a guardian who may or may not be somebody you choose, all right? So the call to action to this, review the account titles and beneficiaries every single year. Put it in the calendar. I've said this many times. If your kids are minors, set up a trust to manage the money on their behalf, okay? I'm going to stop there because these questions are just the tip of the iceberg, but they're often, I get these a lot, and they're the most urgent. And the great wealth transfer, it's not just the name of this, it's also what is happening, whether we plan for it or not, okay? When you do this right, the legacy becomes a gift, not a burden. I'm going to continue these FAQs. I like the format. I love that these are real questions that people are asking, and I get them a lot. And I think it's really valuable for the folks that are listening or watching. I hope it is. And until next time, make it a great day.
Thank you for listening to the Great Wealth Transfer Podcast. If this podcast resonates with you, reach out to SixPoint Financial Partners at 585-485-6048 or email dpulcini@sixpointfp.com.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. All investing involves risk, including loss of principal. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. Information here is provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither SixPoint Financial Partners, Private Client Services, nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of SixPoint Financial Partners. They do not necessarily represent those of Private Client Services, RFG Advisory, their employees, or their clients. This commentary should not be regarded as a description of advisory services provided by SixPoint Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives through Private Client Services. Member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory LLC, RFG Advisory, or RFG. A registered investment advisor. Private Client Services, SixPoint Financial Partners, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.